There are countless strategies that high-income earners use to reduce their tax bills. In this video, we are going to explain and compare every major tax optimization strategy. Tax optimization strategies can be broadly categorized by answering two simple questions. Firstly, are you willing and able to relocate to another country? And secondly, are you willing and able to relocate your business and/or assets to another country? Generally speaking, the more flexible you are when it comes to these two questions, the more will you be able to reduce your tax bill. If you move your personal residence abroad, you can minimize all types of personal taxes, including taxes on personal income, capital gains, dividends, and consumption. If you just move your business or assets abroad, whether that is in full or partially, you can benefit from lower business and investment taxes. This means lower corporate income taxes, capital gains taxes, and property taxes. Ideally, you would relocate all three: your personal residence, your business, and your assets abroad for the highest tax savings. Now let's talk about the actual strategies we can use in our four scenarios. Let's start with the first scenario, keeping your residence and business in your home country. Even then, you have a multitude of strategies at your disposal. You can maximize deductions. You can structure your personal compensation as stock options or dividends to slightly reduce or delay tax payments. You can access company profits indirectly by borrowing money from your business. There are no taxes on loans. You may also borrow money from a bank, using your shares in the business as collateral. The last two options don't incur personal income taxes. However, you would have to pay interest. And the company itself would still be liable to corporate income tax. Depending on where you live, there's usually a range of low-tax savings plans that allow you to invest at lower tax rates, as long as you keep the money locked up for a minimum number of years, for example for retirement. If used effectively, all these strategies can easily halve your tax bill from an average 50% to around 25% without moving abroad. To avoid taxation of your company, however, you would need to relocate your business abroad. A number of jurisdictions have 0% tax on company profits. Nonetheless, moving your business there is easier said than done. In order for your foreign company to be tax-free, you need to provide evidence that the business has its operations abroad. This is referred to as nexus, or physical presence. Physical presence can be achieved through a variety of ways. For example, by renting an office and hiring employees abroad. Without physical presence, you won't get a business bank account, and your home country will treat your foreign business as a domestic company for tax purposes. When we look at the jurisdictions without corporate income tax, we see that they are mostly small islands, such as the Cayman Islands. Establishing a physical presence there is difficult and expensive. For example, due to efforts by the United States and the EU to establish a global minimum tax, formerly 0% tax countries such as the Bahamas and the United Arab Emirates have introduced corporate income taxes. If you want to set up a company in a low-tax country and meet the physical presence requirements, the United Arab Emirates, for example Dubai, remain one of the best options due to several factors. Its corporate tax rate is just 9%. There are generous tax exemptions. Companies in certain industries, such as logistics and manufacturing, remain tax-free. Holding companies owning passive investments are 100% tax-exempt. Profits below 375,000 dirham or around 100,000 US dollar per year, are untaxed. And the Small Business Relief Program exempts businesses with revenues below 3 million dirham, or around 800,000 US dollar per year, until at least 2026 from income tax. And most importantly, it is much easier and plausible to have a physical presence in the UAE compared to other tax havens. Offices are relatively affordable, and skilled employees are easy to find. If you want to establish a UAE business that meets all physical presence requirements, contact us or schedule a free consultation by visiting our website, thedubainavigator.com. Even if you relocate your business abroad or set up a foreign holding company for your assets, 3 issues remain. If you still live in one of the countries with a residential-based taxation system, you will need to pay taxes in your home country on any compensation you receive from the foreign business, for example a salary or dividends. You would also be liable to capital gains tax in your home country should you sell the foreign company or assets for a profit. Furthermore, if you have multiple businesses, they may be subject to transfer pricing regulations. In other words, you can't just invoice for random amounts between them. Any transactions have to be based on market values. For more info, check out our video on transfer pricing. You can avoid some of these issues, including capital gains taxes, if you put the assets into a trust or foundation. When you place assets into a trust or foundation, you lose direct ownership and control. This brings tax advantages. You will still be able to take out money, but have to appoint a manager to oversee your assets. The setup fees for these structures can be substantial and are only reasonable for asset amounts above 1 million US dollar. Instead of setting up a trust or foundation, you may reduce capital gains taxes, as well as personal income taxes by simply relocating abroad and giving up your home country residence altogether. Where would you move to reduce or eliminate personal income taxes? Numerous Caribbean and Arabian Gulf countries have 0% personal income tax rates. Again, most of these are either small and remote or very costly. The UAE and Dubai are one of the most accessible locations among these. It is relatively easy to obtain a residence visa for Dubai, as we discussed in another video here on our YouTube channel. Setting up a basic company or even just investing around 540,000 US dollar in real estate will qualify you for a residence. Dubai is the largest city in the world without personal income tax. There are also no capital gains taxes, dividend taxes, inheritance taxes, or property taxes. And the cost of living is much lower than in other 0% tax jurisdictions such as Monaco or the Bahamas. Aside from these 0% tax jurisdictions, there are several countries offering tax holidays to high-income immigrants. Countries such as Greece and Italy allow you to pay a lump sum tax amount every year, instead of a percentage of your income. In Greece, for instance, new immigrants qualify for a lump sum tax of around 100,000 US dollar, no matter how high your income is. Of course, these programs are only attractive if you earn above $1 million US dollar per year. If you're making 300,000 US dollar a year and pay a 100,000 annual flat tax, your income tax rate would still be 33%. Additionally, these programs often come with other requirements, such as a minimum investment in the country to qualify for a visa, or limit the duration of your benefits, for example to 15 years in the case of Greece. Let's assume you choose to emigrate to a country such as the UAE. Depending on your home country, you must ensure that your center of life has moved to the UAE. This means you can't keep a vacant property in your home country, or spend significant amounts of time back home. The exact requirements depend on your home country. There may also be exit taxes. When moving abroad, the tax authorities in your home country may ask you to pay capital gains taxes on any assets you hold at the time of your move. For a personalized assessment of your situation and how you may avoid or defer exit taxes and establish your center of life in Dubai, contact us at thedubainavigator.com. If you move abroad but your business stays in your home country, you are still subject to paying corporate income taxes there. Similarly, dividend payments you receive from your home country business may be subject to withholding taxes in your home country. For example, if you live in Dubai but receive dividends from a corporation in the US, you will need to pay a 30% withholding tax to the US government. As a result, for total tax optimization, you would need to relocate your business, your assets, and your personal residence. While there are a number of countries you can move to, only the UAE meets all criteria from low corporate taxes to no personal income taxes. You can obtain a 2-year renewable visa by simply establishing a business, even if you don't generate revenues. And 10-year golden visas are available for a $540,000 investment in real estate or a fixed deposit with a local bank. While some jurisdictions, such as the Cayman Islands or Monaco, offer similarly attractive tax advantages, they are much more expensive. Finding a place to live there will cost a multiple, and they don't have the infrastructure of a large city. If we look at schemes offered by countries such as Greece, we see that your taxes will still be substantial, and any benefits may be temporary. Similarly, if you're a business owner, those countries are among the least competitive when it comes to establishing and running a company, both in terms of taxation and regulation. For a personalized relocation strategy that takes into account your home country and business, simply schedule a free call via our website, thedubainavigator.com. We assist clients during the full relocation process, starting at exit tax minimization to setting up a UAE business. If you are a US citizen, there's more you need to consider. You will still be required to file for and pay US taxes even if living abroad, due to the US's unique citizenship-based taxation system. However, there are tax deductions available, such as the foreign earned income exclusion, on income up to around $127,000 per year as of 2024. That means only income above that threshold is subject to US taxation if you live abroad. Similarly, if a company outside the US is more than 10% owned by a US citizen, the company will be subject to the 10% GILTI tax in the US. These issues may be avoided in one of 3 ways: by renouncing US citizenship, by transferring the company to an offshore trust or a foundation, or by using nominee shareholders for the company. We specialize in finding the most cost-effective solution for your situation. Contact us for details. Thank you for watching.